Abhinav, fantastic to have you back on ET now. Thank you for joining us. The non-believers, Abhinav, are saying that it is only liquidity and cost cutting which is taking markets higher. It's a rising tide which is unlikely to sustain. So what is your sense? Do you think the kind of recovery data, what we've seen on the rural front, on the corporate front, from auto companies, from consumer durable companies, is only hope and hype?
So you're absolutely right. I think the rally in the markets from the lows of March has taken everyone by surprise. And let me break it into two parts. So the first part being what has caused the market rally and where has the street been surprised? And then the second part would be, would this sustain or not? So to answer the first part, I would say that the market rally began with the liquidity thrust. After the markets bottomed in March, we saw commentary from the central banks globally, as well as the various governments, which was related to fiscal stimulus as well as the monetary stimulus. And that is what gave confidence to the investors that it could be a very liquidity-driven rally that can happen from the lows that I just referred to, which you saw in March. And that was when the markets, like the Nifty, rallied from sub 8,000 levels to nearly the February levels in this 5 or 6 month period. Interestingly, the S&P 500 also has recovered all of its losses, and it's actually up around 1.5% year to date. So the rally initially started with belief that there will be a huge flush of liquidity. But then more than this, what has taken the investors by surprise is that the companies have delivered earnings which were better than the worst expectations. So if I just look at the earnings in India, in the June quarter, right after the worst of the pandemic happened, you actually saw that the companies surprised us on the cost front, while they were still struggling on revenues. But to their credit, as I said, they did well on the cost front. What they have continued after June is that they have not only maintained their cost discipline, but have been able to get much better sequential revenue growth as well. Hence, the results that we have seen for the September quarter till now have actually been a combination of a bit of revenue beat and also a continuation of the margins beat. And hence, we have a scenario where, as of today, roughly 40% of the Nifty companies have reported numbers, and the earnings for those 40% of the Nifty companies are up 10% year on year. The EBITDA is actually up 20% year on year. And this is actually well ahead of what Street had expected for these set of companies. So I would say that at least on the earnings front till now, things have been quite good. And
Abhinav, if the economy is healing, why are banks suffering? Because banks are a proxy to economy. Every time economy goes up, economic transactions have to pick up, lending has to start, loan activity has to start. But markets, while they are excited about economic recovery, banks are completely getting whack out of shape.
On a question, on a point about the macro looking up, so we did an analysis recently, and we actually have a broad recovery index. It's an index of 21 variables that we track. And as of September, the broad recovery index was at 90% of the pre-COVID level. So we are like, so what that index is saying is that we are at 90% of the normal already. And we also have another index, which is a narrow recovery index, which factors in a few more high frequency data indicators. And that index is indicating that even in October, we have seen further sequential recovery. So yes, the sequential recovery since the unlock phase started has been very good. And that is what has driven most of the market, barring the financials. On the financials, it has been the biggest underperforming sector till now in India, not just in India, but even globally as well. And we actually had done an analysis where we showed that the price to book for the banking sector index is at the biggest discount to Nifty since 2009. And that's a lot, right? Biggest discount to Nifty since 2009. and the valuation of the banks are at 2 standard deviation below their mean of the last few years. Now, why is that sector underperforming? I would say a couple of reasons. One is that there are some investors who are hoping for full clarity on the restructured assets before they get more deep into the sector. And that clarity on restructured assets is only going to come by December 31st, because that is the timeline which has been given by the regulators. So that is one. And the second factor I would say is that there were already some large capital raises, primary capital raises, which had been done by banks and housing finance companies in the month of July and August. So investors have been quite well positioned, and some investors are also overweight, especially foreign investors are overweight the financial sector. So there is, at least till now, somewhat less interest or incentive to add until you get further clarity on the asset quality situation. Having said that, Nikunj, our view is that the banks have been very conservative in provisioning for the March quarter as well as the June quarter. Some of them have reported results for the September quarter as well, and they remain conservative. We believe that the provisioning which has been done by the banks till now more than covers the worst case scenario which may happen. And that makes us believe that the street is probably just too worried about the asset quality, whereas they should not, because of the provisioning which has already been done. And even on the positioning which I referred to earlier, while the foreigners are overweight, their overweight is the lowest in the last 5 years, while the domestic investors are actually underweight the financials by roughly 300 basis points. So adding up all of this, recently we actually raised our
Okay, now let's look at the other side. For somebody who is not very bullish on banks, and the case is very simple, who will borrow from banks? Apart from retail growth, you also need a corporate growth. And big companies in India which have ability to raise debt and service debt without going belly up and creating an NPMS are all deleveraging. Ultratech has bought debt down. Reliance has bought debt down. Tata Motors is looking at reducing debt. So somewhere the proposition of raising debt in this kind of an economy, which is morphing to be a more digital economy, is not there. So on an aggregate basis, that could hurt corporate banks. How would you defend this argument?
Yes, that is absolutely true, and that probably also explains why the banks have underperformed. Because at this point of time, we do not have the full confidence on the entire gamut of macro activities resuming to their pre-COVID normal. So while I mentioned a few things about banks providing a lot, being conservative, and covering up for the potential asset quality negative surprises, but the other factor which is important as well for bank valuations is growth. And what you just mentioned now covers the growth aspect. So if the consumer sentiment has not picked up, if there are a large section of people who have either lost their jobs or who have seen salary cuts, it'll take some time for their confidence to come back. And that is probably the reason why there is a lack of confidence in the ability that banks can go back to a level of 15-20% loan growth. If you see the recent numbers from the banks, barring one or two banks which are still growing in their high teens, most of the other banks are still growing at less than 10% or at close to flat levels. And unless the growth for the banking sector, both in terms of loans as well as deposits, unless it goes back into double digits, it will be difficult for the banks to command the same kind of valuation that they were doing, when we were at pre-COVID levels. But as I said, the valuations are just too beaten down. If banks are trading at 2 standard deviation below mean, and they are trading at the biggest price to book discount to Nifty that we have seen since 2009, it does mean that even the growth concerns are probably factored in. and which is what gave us the confidence to further raise our overweight on the bank.
Where do you think IT sector is headed? Numbers have been strong. IT companies are saying, look, more than cost cutting, it's a new wave of IT cycle which has started. Do you buy the bullish thesis which IT companies are sharing?
Fundamentally, what we are saying is that this is a beginning of a new cycle. So you're absolutely right about the fact that a lot of businesses are adopting work from home going forward, and even post-COVID, you would see that a large population of the workforce may either entirely work from home or split time between an office location and home. And we've clearly seen that reflect on the technology sector globally in the last 5 or 6 months. While the Indian IT sector has done really well in terms of results and in terms of stock price performance, globally tech stocks have done very well. You look at the Nasdaq, you look at the tech companies, in the other countries, in developed markets and emerging markets. Tech has been clearly, the best performing sector, this year. Now, whether we have seen enough of this for Indian IT or this could continue, I think that as far as the delivery of numbers, so large deal wins, margin surprise, top line growth, I think that is going to continue for quite a few quarters more. The change that we are seeing because of COVID is actually a structural change out there. And what we have also seen is that the tech spending from the large corporations has actually somewhat decoupled from the macro growth and from the growth of those corporations themselves. Earlier, like if you go back 10 years or if you go back 5 years, there used to be a very high correlation between the tech spending and the macro growth and the corporate earnings growth. But over time, that decoupling has begun, and COVID has actually accelerated that decoupling. And hence, this is clearly a structural change from a fundamental perspective.
Now, Abhinav, next year would be a base year and a tricky year for IT companies to look at the growth. The year-on-year comparisons will not be real because of COVID. But where do you think these stocks are headed? Are they likely to grow both in terms of EPS and PE?
So what we are saying is that the performance of the IT companies will be driven more by earnings delivery. We don't see a situation where valuation can expand further, because there are a few companies now in the IT sector which are trading at their lifetime high valuations. So the scope of PE to expand further is extremely limited. If at all, there could be a bit of a derating in the PE if the earnings don't come through. So any further stock performance in the IT sector is going to be more earnings delivery led rather than valuation re-rating led.
Abhinav, what is your view on the quality of earnings which have come? Last couple of years, the flow of earning was a function of inflation, crony capitalism, also rupee depreciation added to margins for exporters. Those factors are not at play. Crony capitalism is now history, at least at corporate level. Inflation is going to remain low for a long period of time, and rupee is also stable. How will this impact the quality of earnings?
Yes, so I would say that the earnings in the initial phase of this recovery would be driven more by cost control initiatives, which will lead to margin expansion. And we have done quite a few virtual events where we have connected corporates with investors. And one of the common themes which has come out is that some of these cost savings, which were necessitated by COVID, those savings are actually going to be more permanent. So a lot of the companies across sectors are looking to alter their business model in such a way that they make some of these cost savings more permanent. And I think that is one of the going to be the key levers for continued margin expansion for some more time. In terms of the other aspects, I agree that the currency depreciation or the inflation-driven growth will be missing going forward. But what we will see from the lows is a sequential pickup in the top line growth across the companies. We've already started seeing that in Q2 in the September quarter, where it was not just a cost surprise, but we also saw quite a few companies delivering good quarter-on-quarter top line and volume growth. And we expect that that is going to continue into the December quarter and into the March quarter as well. In fact, when we also look at our GDP assumptions for the full year, so for the full year, we are at -8%. But when you look at the sequential numbers, in Q1, we saw -24% GDP. Q2 would be closer to around -9% or so. It's an estimated number. The numbers will only come out in November. And then in Q3, we expect only a small decline in GDP, whereas in Q4, we actually expect a small pickup in GDP growth. So similar to what we have projected for GDP sequentially, we also expect the top lines for the companies to behave in a similar manner. So a combination of the cost levers along with sequential top line growth will dictate the earnings momentum for the next 2-3 quarters.
Why auto sales coming back? There have been job losses, there has been stress in terms of disposable income. Auto is the function of disposable income. You buy autos or you buy a car or a two-wheeler when you're feeling happy. A lot of that is need-based, but a lot of it is also associated with your ability to spend and your ability to predict cash flows. Despite crunch in the economy, auto sales are back. What is aiding to this?
I think your last phrase, Nikun, sums it all. I would say that initially, when the numbers started to pick up post the unlock beginning, it was a lot to do with the pent-up demand. So it was the pent-up demand which reflected in the monthly numbers for June and July, surprising positively. And once you saw the pent-up demand reflecting in the monthly numbers, we also see a greater confidence coming in an expectation that now we are in a much more steady recovery phase. And people have actually got the confidence that it's not only something that I should buy because I could not buy in February or March, but that positive consumer sentiment that we have seen improving gradually, that is actually encouraging the consumers to actually make real decisions of purchase because they expect the economy to clearly come back to a pre-COVID level, not too far away. As I said, we expect a sequential GDP recovery every quarter from here on. And if you look at the broad recovery indicators, we are already at 90% of pre-COVID level. So it's not just pent-up demand. Initially, it was pent-up demand, but now it is a pickup in overall consumer confidence, probably also driven by the festive season. We are right now in the midst of the festive season, and a lot of the purchases are also related to the usual festive season demand and spending that you normally see. And the spending is happening in items like even two-wheelers and cars. You refer to autos, so in particular two-wheelers and cars, these are more of early cycle recovery plays. So when you look at the auto sector and you break it up into different parts, usually it is the early cycle plays which see a pickup in sales, and it is only later that you see the mid-cycle and end cycle recovery plays pick up. So what normally begins with a pickup in two-wheeler sales or passenger vehicle sales eventually moves on further to commercial vehicles, buses, and so on. At this point of time, where we are seeing buoyancy is more in the low-end cars and two-wheelers.
And finally, the big question: US presidential outcome. What is your housework saying? Are we in for a blue wave? If we are in for a blue wave, what kind of permutation combination could we be staring at?
Yes, US elections clearly are going to be very critical for the markets because what is impacted by that? In the near term, there is clearly an expectation that the amount of fiscal stimulus that could be announced would depend on the result of the elections. and the kind of result that you see. Like for example, what we are saying in our global strategy report is that the market at this point of time is factoring in a blue wave. And if you have a scenario where there's a victory for Joe Biden, and if the Democrats come back in the Senate, in that scenario, you will see a big US stimulus, and that is going to also lead to a weaker US dollar. And a weak US dollar is actually positive for risk assets and emerging equities. And historically, if you go back and do an empirical analysis, you would see that within 3 months of US election results, usually emerging markets outperform. And if you also look at how markets react to a Democratic victory versus a Republican victory, at least as per past scenarios that we have looked at, the markets have reacted more positively to a Democrat victory as opposed to a Republican victory. But net, ultimately, it's going to boil down to whether the decision that we see by the end of next week, whether that's a contested decision or a split decision. And if it's a contested or a split decision, then there will be uncertainty in the market, and you will see that reflect in the market valuations, in the move of the US dollar, and that may go on potentially for a couple of months, even into January. On the other hand, if you actually see a straightforward, clear decision, and as I said, in the base case, clearly it looks like the market is preparing for a blue wave. In that situation, the market will start factoring in strong fiscal stimulus, strong US growth, and a weak dollar, which will fuel a risk rally into next year.
All right. Really appreciate your time, Abhinav. Stay safe and thank you for joining us.